When you hear financial news, you often hear about the US dollar index. It's a term that gets thrown around a lot, but not everyone knows what it actually means. But what is it really? Let's break it down. Think of it as a report card for the dollar, measuring its strength against a basket of 6 major world currencies. Essentially, it's a way to gauge how the dollar is performing on the global stage. These currencies include the euro, yen, and pound, as well as the Canadian dollar, krona, and franc. The index gives us a single number that shows if the dollar is getting stronger or weaker compared to its key trading partners. This number is crucial for investors, policymakers, and anyone involved in international trade. Why does this matter? Because the dollar index is a powerful indicator of global economic health and investor confidence. It can signal shifts in economic trends and help predict future market movements. When the index rises, it means the dollar is gaining strength, often due to a strong U.S. economy, higher interest rates, or global uncertainty. These factors can make the dollar more attractive to investors. The dollar is seen as the world's most stable currency, so in turbulent times, money flows into dollar assets, pushing the index higher. This flight to safety is a common reaction during economic crises. Right now, the dollar index is making headlines, climbing to a 3-month peak of 99.89, its highest since August. This rise is noteworthy and has significant implications. This surge isn't random. It reflects a major story unfolding in the U.S. economy and at the Federal Reserve. Decisions made by the Fed can have a direct impact on the dollar index. The value of the dollar affects the price of imported goods, international travel costs, and even the cost of doing business abroad. It also impacts the profits of American companies operating overseas, influencing their bottom lines and stock prices. A strong dollar makes foreign goods cheaper for Americans, which can be a boon for consumers looking for imported products. However, it also makes U.S. exports more expensive abroad, which can hurt American manufacturers and exporters. So, the movement of this single index ripples through the global economy, influencing everything from corporate earnings to international trade balances. It even affects the price of gasoline, as oil is traded globally in U.S. dollars. Understanding the dollar index is the first step to understanding the bigger economic picture. It's a key tool for anyone looking to navigate the complexities of the global financial system. It might sound odd at first, but the US dollar is actually getting stronger right now, even after the Federal Reserve just made the decision to cut interest rates. Normally, when a central bank lowers rates, it makes that country's currency less attractive to investors, since they get less return for holding it. But this time, the Fed's message was the real game changer. After cutting rates by a quarter point, which many expected, Fed Chair Jerome Powell signaled that this might be the last cut for a while, hinting at a pause in further easing. Investors took this as a hawkish signal, meaning the Fed is confident about the economy and not planning more cuts soon. In financial speak, hawkish means the central bank is more focused on fighting inflation than on stimulating growth. Instead of weakening, the dollar actually rallied sharply, as investors realized U.S. rates would likely stay higher than they previously thought, making U.S. assets more appealing. Many traders had been betting on a series of rate cuts, but the Fed's surprise pause made them rush back to the dollar, reversing their earlier positions. This sudden shift in expectations is what's driving the dollar's powerful rally to a 3-month high, catching many off guard. The lesson here: markets move on expectations and forward guidance, not just on the actual policy moves. The Fed managed to support the economy with a rate cut, while also signaling stability and confidence to global investors. That's why, instead of triggering a dollar sell-off, the move actually boosted the currency's value. In fact, the opposite of what most expected happened: the dollar surged. The U.S. is now seen as a place of stability and higher returns, especially compared to other major economies facing uncertainty. That's why global capital is flowing into the dollar, at least for now, as investors seek safety and better yields. Sometimes it's not just what the Fed does in the moment, but what it says about the future that really moves markets and shapes global money flows. The dollar's strength right now is all about confidence, expectations, and the power of central bank communication. Behind the scenes, the Fed's decision to cut rates wasn't unanimous. Some regional Fed presidents argued the economy was strong enough without more stimulus. They worry that cutting rates now uses up options too soon and could fuel future inflation. This internal split signals to markets that future policy is uncertain and up for debate. Before Powell's hawkish comments, markets expected another cut in December. Now, that's much less certain. Traders now see only a 68% chance of another cut, down from near certainty. The Fed's internal debate keeps investors guessing, making every statement and economic report critical. For now, the hawkish side is winning, helping keep the dollar strong. The ongoing U.S. government shutdown adds another layer of uncertainty. When federal agencies close, key economic data, like the monthly jobs report, gets delayed. Without this data, the Fed and investors are left guessing about the economy's true health. In this data vacuum, markets turn to private reports like ADP employment and ISM PMIs for clues. These alternatives are useful, but less reliable, making markets more volatile and reactive. A surprise in these reports can cause sharp swings in the dollar as traders scramble to interpret the news. Until the shutdown ends and official data returns, everyone is navigating with limited visibility. Uncertainty reigns, and the dollar's path is harder to predict. The dollar's strength is a global story, not just an American one. Its movements ripple through economies, shaping everything from trade balances to the price of everyday goods around the world. As the dollar climbs to a 3-month high, it's putting pressure on other currencies worldwide. Investors and governments alike are watching closely, as a stronger dollar can mean higher costs for countries that borrow or trade in dollars. The euro, for example, has dropped to its lowest in 3 months, mirroring the dollar's rise. This shift isn't just a number on a chart. It affects European businesses, travelers, and even the cost of imported goods. Europe's uncertain economic outlook and the Fed's hawkish stance make the euro less attractive. Investors are seeking safer returns, and right now, the US looks like the safest bet. A weaker euro helps European exporters by making their goods cheaper abroad, but it also makes imports more expensive for consumers, raising prices on everything from electronics to groceries. The British pound is also struggling, falling on expectations the Bank of England might cut rates soon. This adds to the uncertainty for UK businesses and travelers. Lower expected rates make the pound less appealing compared to the dollar. Investors are moving their money to where it can earn more, and that's increasingly in the US money flows where it earns the highest, safest return, and right now, that's the US. The appeal of US assets is drawing in global capital, reinforcing the dollar's dominance. The Fed's stance makes the dollar the main character on the global stage. Its decisions echo far beyond American borders, influencing economies everywhere. Each currency has its own story, but all are reacting to the dollar's moves. From Asia to Europe to emerging markets, the dollar's rise is felt in every corner of the globe. The dollar's rise is reshaping the global currency landscape, forcing countries and companies to adapt their strategies and rethink their next moves. It's a dance, and the dollar is leading, setting the pace for the world's financial markets, and reminding us just how interconnected our economies really are. The euro is on the defensive, slipping to a 3-month low as the US dollar flexes its muscles. This isn't just a reaction. It reflects real differences in economic outlooks. The Fed's hawkish tone contrasts with the European Central Bank's more dovish stance. Investors favor the dollar, expecting better returns. The British pound is also under pressure, with soft inflation data fueling speculation of a rate cut. The Bank of England's upcoming meeting has traders on edge. With a 1 in 3 chance of a rate cut, the pound is less attractive. Investors are moving out of the pound and into the dollar. Both the euro and pound are caught in the dollar's gravitational pull. The dollar's appeal is growing stronger as other currencies struggle. The dollar's strength is also hitting the Swiss franc, which has dropped to its lowest in weeks. The franc is usually a safe haven, but ultra-low Swiss rates make it less appealing than the higher-yielding dollar. Even safe currencies aren't immune to the Fed's influence. Meanwhile, the Australian dollar is showing resilience, rising slightly as its central bank is expected to hold rates steady. High core inflation in Australia means no rate cuts for now, supporting the Aussie. Each currency's story is shaped by its own central bank and economic outlook. The franc's dip and the Aussie's stability show how local factors interact with global trends. The US dollar's moves set the tone, but every currency has its own dance steps. Interest rate differences are driving the action. The global currency market is a web of shifting stories, all orbiting the dollar. The Japanese yen is under intense pressure, hitting an 8.5-month low against the dollar. The reason? A huge gap in interest rates. The Fed is hawkish, while the Bank of Japan keeps rates ultra-low. This makes the yen unattractive, fueling carry trades, where investors borrow yen to buy higher-yielding dollars. The yen's weakness is so severe that it's nearing levels that have triggered government intervention in the past. Japanese officials are warning traders, but markets remain skeptical. Even hints of a future rate hike in Japan aren't enough to impress investors. Until the Bank of Japan acts decisively, the yen will likely stay the weakest link. The dollar's dominance is clear, and the yen is paying the price. The dollar's ups and downs aren't just for Wall Street, they affect your daily life. A strong dollar makes imports cheaper, helping keep inflation in check and boosting your purchasing power. Planning a trip abroad? Your money goes further when the dollar is strong. But there's a flip side. A strong dollar makes U.S. exports more expensive, hurting American companies overseas. That can impact profits and jobs, especially in manufacturing and agriculture. A weak dollar does the opposite. Imports and travel cost more, but U.S. goods are more competitive abroad. The dollar's value is a balancing act, with winners and losers on both sides. Its movements ripple through the global economy and right into your wallet. Understanding the dollar's journey helps you see how global forces shape your personal finances. The world's reserve currency is everyone's business.